Welcome back to the Deep Dive. It is Tuesday, January 27th, 2026.
Good morning.
So if you're listening to this, you've probably already seen the morning briefing. You've seen the red candles on the chart. You know the headlines are messy.
It is a chaotic morning for sure. The screen is a sea of red, but,
Yeah.
well, the real story is buried deep in the filings.
Which is exactly why our mission today is pretty strict. We are not here to reread the ticker tape.
Yeah.
We are here to isolate the delta. We need to strip away the noise and figure out specifically what has shifted in the market structure, in the macro environment, in just the last 24 hours.
And it feels like we're in the middle of a massive pivot.
We absolutely are. I mean, think about where our heads were just, 3 days ago? The entire narrative was physical.
It was all Winter Storm Fern, the Texas grid teetering, frozen mining rigs. It was a pure infrastructure story.
And today,
the narrative has completely flipped to financial stress and acute political risk.
it's almost like we traded an ice storm for a political firestorm in Washington.
That's the perfect way to frame it. We've gone from worrying about frozen wires to worrying about a liquidity freeze from a government shutdown.
So there are three massive stories kind of colliding right now.
Exactly. We have BlackRock making a strategic move that,
Well, it fundamentally changes how Bitcoin can generate yield. That's the new signal.
okay,
Then we have this tragic political catalyst that has pushed the government shutdown odds through the roof.
and the last part, this is what really caught my eye. This bizarre divergence where the price of Bitcoin is tanking, but the ETFs are actually buying.
The signal versus the noise.
Let's start with that net new signal. The thing that literally didn't exist 48 hours ago, BlackRock.
Right. They filed an S1 registration statement.
For a new product called the iShares Bitcoin Premium Income ETF. Now, on the surface, that just sounds like another fund. But reading the mechanics, this seems like a different beast entirely.
It's completely different. And I would argue this marks the official start of phase 2 of institutional adoption.
Phase 2. What was phase 1? Phase 1 was simple. Get me access. That was the spot ETF, iBitTake. It was just beta exposure. Price goes up, I make money. Price goes down, I lose money.
Okay.
Phase 2 is about financialization. It's about solving the single biggest problem that institutional allocators have with Bitcoin,
Which is what? That it's too volatile?
that it's sterile. Think about it from the perspective of, say, a pension fund manager.
Okay.
They love assets that work for them. Stocks pay dividends, bonds pay interest, real estate pays rent.
And Bitcoin just sits there.
It just sits in the vault. It's digital gold, sure, but it doesn't generate cash flow. That makes it incredibly hard for a conservative portfolio manager to justify holding it.
So how does this new premium income ETF solve that? They aren't staking the coins, are they? Because the SEC has been allergic to that.
No staking. This is pure financial engineering. The fund holds Bitcoin-likely shares of their own iBit ETF, but then they employ a systematic covered call strategy.
Okay, let's pause and unpack that. Selling a covered call. In plain English, what are they actually doing?
Think of it like this. BlackRock is holding the Bitcoin. They turn to the market and they say, I will sell you the right to buy my Bitcoin at a specific higher price next month.
Right, but not the obligation.
Exactly. And in exchange for giving you that right, you have to pay them a cash fee, a premium, right now.
So they get cash in hand today, immediate income. What's the catch? There's always a catch.
The catch is they cap their upside. If Bitcoin goes to the moon next month, say it rips 40% higher,
They don't get all of it.
they don't participate in all that gain.
Yeah.
They're forced to sell at that lower, agreed-upon price. So they're trading away the moonshot potential for guaranteed steady income right now.
They're monetizing the volatility.
Precisely. They are taking Bitcoin's legendary volatility, which is usually seen as a bug by more conservative investors, and they're turning it into a feature. They're packaging it as yield.
Okay, that makes sense for the investor who just wants a steady yield. But here's where it gets interesting for everyone else. If BlackRock starts selling massive amounts of these call options, what does that do to the physics of the market itself?
It changes the plumbing significantly.
Yeah.
This introduces something called gamma hedging at a massive scale.
I see that term thrown around a lot. Walk us through what actually happens. Who's on the other side of that trade?
Usually it's a market maker, a big bank, or a high-frequency trading firm. Now look at their position. BlackRock sold the call.
So the market maker bought the call.
Right. The market maker is now long gamma.
And being long gamma compels them to do what exactly?
It means they have to trade against the trend to stay neutral. If Bitcoin's price starts to rally, the market maker's position gets riskier. So to hedge that risk as the price goes up, They have to sell some of the underlying Bitcoin.
Wait, so as the price goes up, the mechanics force them to sell?
Correct. And conversely, if the price starts crashing, the market maker has to buy Bitcoin to re-hedge.
So they're buying the dip and selling the rip automatically.
Yes. Their hedging activity acts as a dampener. It creates this massive counterforce to whatever the market is doing. It suppresses volatility.
So if this ETF gets huge, we could see Bitcoin behaving less like a wild speculative commodity.
And more like a mature, structured equity index. That's the thesis. It's the taming of the asset class.
Which is great for stability, but maybe a little boring for people who like the 20% daily moves.
Well, that's the trade-off.
So that's the internal structural shift. But we have to pivot to the external pressure. Because looking at the charts, Bitcoin broke that critical $88,000 support level, and that wasn't because of covered calls.
No, it was not. This is macro-political contagion. We are seeing a classic risk-off environment, and it's being driven by the sudden, sharp threat of a U.S. government shutdown.
We've been hearing about a potential shutdown for weeks, though. It feels like the boy who cried wolf.
It always does.
What changed in the last 24 hours to make the market actually panic this time?
The probability spiked. If you look at prediction markets, the odds of a shutdown by this Friday, January 30th, they jumped to nearly 78%.
78%. That is a massive move. And the driver isn't just budget math.
No, it's a very specific, acute political catalyst.
Yeah.
It all revolves around the Department of Homeland Security.
Right, and we need to report on this carefully because it stems from that sensitive event in Minneapolis.
That's the singularity point. The shooting of U.S. citizen Alex Pretty on January 24th has completely fractured the negotiations in the Senate.
So before that event, there was a path to a deal.
There was. Now, key Senate Democrats, including Leader Schumer, have pledged no votes on any appropriations package that includes DHS funding.
They're drawing a line in the
An
sand.
absolute line in the sand. They're demanding accountability before approving funds. And on the other side, Republicans view DHS funding as completely non-negotiable.
An immovable object versus an unstoppable force.
And the clock runs out Friday.
And just to do the Senate math here,
Yeah.
they need 60 votes to overcome a filibuster, right?
Correct. Republicans hold 53 seats. They need 7 Democrats to cross the aisle. But with Democratic leadership whipping votes against the package, that path to 60 has basically collapsed.
And there's a procedural trap here too, isn't there? The House is out of town.
That's the logistical nightmare the market is finally waking up to. The House is in recess until February 2nd. Even if the Senate passed a miracle fix today, the House isn't there to vote on it.
So the market looks at this and says 78% chance the government shuts down on Friday. But the traditional Bitcoin narrative is that it's a hedge against government failure. The government breaks, Bitcoin should go up.
It should, but that's not what's happening. And this is the short-term identity crisis. We're seeing a correlation shift. Gold rallied to $5,000 an ounce today.
Gold is acting like the bunker.
Exactly.
Right.
Bitcoin is trading like a risk asset, like a high-beta tech stock.
Why the difference? Why is gold up and Bitcoin down?
Liquidity. The market views a shutdown as a liquidity crunch. Government workers don't get paid, contracts pause, the economy drags. When liquidity dries up, you don't buy insurance, you sell the most liquid thing you own to raise cash.
And right now, that's Bitcoin. It's the easiest thing to sell to pay the bills.
In the very short term, that is the risk-off dynamic.
Okay, I want to move into our next segment, what's new versus what we knew. Because in a market like this, yesterday's assumptions are dangerous.
Let's run through it.
Topic A, physical mining infrastructure. Yesterday, the narrative was Winter Storm Fern is destroying the network. We saw hashrate falling off a cliff. What's new today?
So what we knew was scary. Foundry lost 60% of its hash rate. It looked catastrophic. But what's new today is the bounce back. The global hash rate recovered from a trough of 663 exahashes per second all the way back up to 854.
In 24 hours, that's a massive V-shaped recovery.
It is. And it validates the interruptible load thesis.
Remind us what that means.
It means the outage wasn't because machines broke. It was an economic decision. Miners in Texas get paid to turn off their rigs when the grid is stressed and power prices spike.
So they make more money not mining than they would mining.
Exactly. They act as a digital battery for the grid. As soon as the storm passed and prices normalized, they flipped the switch back on. It was a feature, not a bug.
Okay, topic B, capital flows versus price action. What we knew was price collapsed below $88,000. Over $750 million in long leverage got flushed out. Sentiment hit fear.
The assumption was everyone is selling.
But what's new?
Here's the divergence. The ETF flow data for January 26th. Despite the price crashing, U.S. spot Bitcoin ETFs actually saw net inflows of about $6.8 million.
So price dumps, but ETFs are buying.
It's a small number, sure, but the direction is everything. It snapped a 5-day outflow streak. It tells us the selling was driven by derivatives, the paper hands, the leverage traders getting margin called.
But the ETF investors, the sticky money,
They absorbed that supply. They bought the dip. That's a crucial distinction. The price action was a leverage flush, not an institutional exit.
what about other assets?
Broader, we saw robust inflows for Ethereum, over $110 million, led by Fidelity. Even XRP saw inflows. Institutions were accumulating across the board.
A bullish signal hidden in a very bearish chart.
Precisely.
Okay, topic C, corporate strategy, Metaplanet in Japan. What we knew yesterday was they reported a huge impairment loss, $680 million. Looked like a disaster.
Looked terrible on a balance sheet. But what's new is their forward guidance released today. They're projecting 80% revenue growth for fiscal year 2026.
How do you go from a $680 million loss to 80% growth?
It's a pivot. And this ties right back to our first segment with BlackRock. They're explicitly shifting from passive holding to active yield generation.
Like selling covered calls.
Very similar. They're telling shareholders, ignore the accounting loss. That's just a rule. Look at the cash flow we're going to generate.
So the theme is yield. Everyone is trying to squeeze juice out of the orange.
That is the defining trend of 2026 so far. Making the asset work.
Oh, let's move on to the regulatory landscape. It feels like we're just looking into a void right now.
It is a vacuum. And in politics, vacuums get filled with bad news. The physical weather in D.C. has delayed the key legislative events we were watching.
The Senate Ag Committee markup, the SEC CFTC meeting.
All pushed to Thursday, so the positive headlines we were hoping for literally got snowed out.
But the bad news didn't take a snow day.
No, it did not. We have to talk about the poison pill. Senator Roger Marshall wants to attach the Credit Card Competition Act to the Crypto Market Structure Bill.
The Credit Card Competition Act. The banks must hate that.
They hate it with a passion. It threatens the Visa-MasterCard duopoly. So by stapling this to the crypto bill, Marshall is basically uniting the entire banking lobby against the crypto bill.
He's making the crypto bill radioactive to pass his own agenda.
That's the strategy. It reduces the chance of a clean passage for crypto regulation. So now we have a legislative hostage situation,
Yeah.
and the market is just staring at that and the shutdown.
It really is a perfect storm.
And yet, the flows keep trickling in.
So let's wrap this up. For a listener trying to navigate the next 48 hours, what is the strategic summary?
The market has mechanically deleveraged. That part is healthy. We flushed the gamblers out. But we're capped by an immediate political ceiling, which is the shutdown threat.
So we're bouncing between a solid floor of institutional demand and this lower ceiling of macro risk.
Exactly.
What are the key levels or signals we should be watching?
First, watch $87,000. We're trading right around there now. If we lose that, the next support is probably down near $84,000.
And second,
The Senate negotiations. Any sign of a continuing resolution, even a short-term deal to kick the can down the road, would likely spark a massive relief rally.
and finally,
Watch those ETF flows. If we see another day of inflows today, Tuesday, despite this ugly price action, it confirms that the smart money is treating this as a buying opportunity.
here's a final thought to chew on. We are seeing a market that's bifurcating, splitting into two distinct identities. On one hand, you have Bitcoin as the political football, the asset that crashes because of a budget fight in D.C. On the other hand, you have Bitcoin as the yield-generating financial instrument, the asset BlackRock and Metaplanet are building.
It's a battle between its past and its future.
So, which identity wins in 2026? I have a feeling the answer to that question determines where the price goes next. Thanks for listening to The Deep Dive. We'll be tracking the delta so you don't have to.
Stay safe out there.